how does then, this market start to actually get better from an equity perspective, and where do you find value in the bond market as well? I'm just talking about China to begin with.
Yeah, I think the risk sentiment has been very weak. You can look at it through the downgrade of forecast by economists. You can look at the surveys of positioning or bond spread, which has been very wide on the China, particularly the private sector of them. So we look at the recent price action, and it seems like there is a bit of floor with some of the, even though not quite strong stimulus that you highlighted, the market is feeling like there could be more to come.
And it's a case of bad news being good, because if you get some bad news, they'll think that perhaps they're going to be ramping up stimulus. So this is
almost like pushing them to do something. So if you look at 2023 China GDP growth number, it's not that difficult to achieve a 5% growth, which is what they stated they wanted to do, from the very, very strong first quarter. So what we're looking at is like the third quarter and fourth quarter likely to be kind of quite a bit slower, maybe 2.5%, 3.5%, kind of between those two quarters. And I think the policymakers, if they want to get to a 2024 growth number, which is close to 5%, I mean, they need to put some measures in now in order to get that confidence going.
All right, I want to just ask you about regionally speaking. Is it now, given where the Fed is with this pause or skip, what difference that they are, but I don't know, does that move the needle for corporate debt in this part of the world? Because some are suggesting that we should be going away from the short duration towards a long duration. What's the deal? What is your thinking on this?
From our standpoint, duration, it's a bit of a difficult call at the moment with Treasury yields at about 3.75%. We look at it from a valuation framework where real yield could still be somewhere around positive 0.5% to 1% in the U.S. Now, the inflation part is the more difficult part to assess, but let's say it tracked back down to 2.5% to 3.5% over the course of the next 12 to 18 months. And with that, if we have confidence that the Fed, after all these rate hikes, will put inflation back into that trajectory, maybe weaker growth, and also some of the base effect, panning out.
Yeah, but I mean, in this part of the world, it does seem as though regional central banks are done with their hiking cycle, and they've actually perhaps not had to be nearly as aggressive as the Federal Reserve. I mean, when you've got 2% interest rates in Thailand, and they're the highest in, I think, something like 15 years or something or the other, you've got to say that perhaps these economies are maturing, and they perhaps don't have to look at the Fed as much as they did.
They might be one of the few that would be hiking rates, but when we look at other central banks, they have pretty much finished tightening. You mentioned this week that Bank of Indonesia and Bank of Central Philippines will be meeting, but they are likely to be on hold. And China, we have also talked about that they will likely cut the LPR. And I think inflation is not a problem for most of the Asia region, or at least they're going into a pretty downward trajectory and maybe reaching some of the central bank inflation target by the end of the year.
Yeah, go back to fixed income, having a look at high-yield corporate debt here. Now, it's been absolutely going crazy. I mean, triple C-rated category here, and we're talking about the best performing class globally. Have you had exposure here, or will you be getting exposure here? And, why is this happening? Because it shows confidence that perhaps the economies are more resilient, if anything.
We run Asia high-yield strategy in this region that includes some of the triple Cs that you mentioned. And spreads are quite wide, and a lot of the sentiment has been weak, but lately, because of the China stimulus talk, I think there's been a bit more kind of constructive sentiment in the market. We have seen, sellers have already sold. Cash levels are relatively high. There has been no material inflow or outflows in this asset class. So I think with that, some of the cash might be put to work, even though the cyclical horizon, you might see, let's say, weaker U.S. growth, and maybe still the Fed is not done. But you are getting paid for that.
Yeah. And, with all this noise, I mean, you're paid essentially to try and make sense of it all. Where does that leave you strategy-wise, and what are you at the moment really betting on?
I think from some of the more kind of fundamental standpoint, we see Indonesia and India being two pretty positive secular story. Where they have decent growth, inflation being in check, good demographics, and maybe could be a beneficiary navigating between the U.S. and China geopolitical tension. So foreign exchange might be one way that we play that. And apart from it, I think some of the tourist-related, travel-related sector could still have some upside. Airlines and travel are picking up, but they are not back to 2019 levels. So some scope for the earnings and others to pick up from there as well.